heard of this term called creative accounting.
Okay.
Toshiba in Japan and Tesco in the UK, not in Malaysia, they push back on their charges. They actually hide their company's losses for 7 years. Welcome back to Taylor's Take. In this episode, we'll be exploring creative accounting and accounting ethics in general. My name is Thum Penny, and today I'm honored to be joined by Mr. Emir, lecturer from ACCA. So Mr. Emir, I heard that accounting ethics is important because of 3 main points. 1, it maintains trust and also protects the stakeholders. That's 2. Number 3, it prevents fraud. Can you please elaborate on these 3 points?
When we talk about accounting ethics, okay, it's about the financial info that they produce, okay? They make it transparent. Those financial information will be very useful to the public, for example, investors. They need those info to make informed decision about any investment opportunities that they try to make.
So, Mr. Emir, in Malaysia, we heard of a lot of fraud cases. So, why does this happen? Like, what makes these people commit fraud, especially in accounting?
In general terms, there are 3 reasons. The first reason, I'm pressured. Okay, I owe money from loan shark. I feel pressured, I don't have enough money, so I commit this fraud. I steal money from the company. And then second reason, because there is an opportunity for me to do this fraud. For example, I'm the only one managing the accounts, so the opportunity is then. The third can be, I try to rationalize. I do this because, I did not get increment before. I do so much for this company, but I didn't get promotion. So I steal something from the company to rationalize.
I heard of this term called creative accounting. From my understanding, it's a way of manipulating financial data so that a company's financial performance can look presentable.
The main idea of creative accounting is something like you mentioned just now. The keyword, somehow we are talking about manipulation. Is it acceptable for us to manipulate? Of course not. Okay, the first example is we call as income smoothing. Because the idea of income smoothing is for the presentation of all those info to look nice, to look stable. Okay, you imagine we have 3 years. 2020, your profitability of the company is 10 million. Second year is maybe 5 million. Third year, maybe 8 million. So when we talk about income smoothing, it is when company, they try to smoothen the income so that it looks stable.
Actually, Toshiba in Japan and Tesco in the UK, not in Malaysia. Both of them have really similar problems, is that they push back on their charges, they hide their company's losses and their costs. But the difference is Japan, they have a really strict culture. They actually hide their company's losses for 7 years because of their culture to respect the superior and stuff.
I would say maybe poor corporate governance, or even though we have a lot of standards that we apply nowadays, but still, when we talk about accounting standard, it's about the standard of all the items in our financial statement or financial information. Okay, because they follow exactly what international accounting standards say for this property just now, or this is how you should record your costs. So we may not have issue of manipulation because you follow exactly what should be done.
To conclude, we as audiences should learn from these case studies to know that some of these companies are not actively doing their accounting records. We as audiences should practice caution when using, reading, and also presenting financial data, as according to what we have talked about today. Thank you so much for watching this episode of Taylor's Take. Comment down below what other topics you'd like us to discuss on.